really want you guys to see what I'm about to show you and why you should understand supply and demand is worthless if you don't know this one key factor. Okay, now I'm going to just get the cat out of the bag right away, but the only way supply and demand can be worth it or is valid and is good to trade is only when there is liquidity inside supply and demand. Now, let me just show you an example quickly to show you how people look at supply and demand versus supply and demand with liquidity. Okay, so the first example is this. You can see prices are going bullish. In this scenario here, a lot of traders out there, including myself, have actually been caught in the trap of looking at supply and demand where you see a low and a high, a low and a high, right? You can also see it bearish, of course, but we don't need to do the bearish because it's just the opposite, right? So supply and demand is looked at where we have a low in the market, a break of structure, a high, right? Another low created, right? And another high. So it's just creating order flow in the market. Essentially, you're taught as a trader to look for, swing lows, swing highs, swing lows, swing highs, higher lows, higher lows, higher highs, higher lows, right? So that's all good. But as we all know in trading one sort of strategy and or looking at one concept isn't enough in trading. We all know that. Okay. You need to incorporate other methods in there. Okay, that could be whatever you want here from here. Liquidity, obviously, break and retests, SMC strategies, ICT strategies, whatever it is. But supply and demand should not just be traded alone by itself. And we all know this, right? Because there's a lot of things that happen inside the market, inside each high and each low, each impulse, right? So you and I were taught, right, highs and lows, right? You buy low here, you sell high here, you buy low here, sell high here, right? However, I'm about to show you another concept, a new concept. It's not really a new concept. However, I'm pretty sure the people that are following me and actually have seen the journey that I've been through when teaching everybody based on supply and demand and other variations, obviously, other strategies. The way we see the market is in this way. Supply and demand goes like this. There's a low created, right? There can be this, right, internal structure, right? Price runs, comes right back down, and then runs back up, right? Now, it's not going to be this smooth, obviously. It's not going to be a playbook, simple playbook strategy like this, although textbook, right? Although it can be. But right here, the two differences between this here, this and this, is that each low and each high is created, but there's no liquidity inside, right? You can see there's no liquidity here, but between this swing low and this swing high, there is liquidity, right? So I'm more prone to trading liquidity, supply and demand versus no liquidity of these supply and demand zones, right? So I can't just look at a swing low when a swing low is created and price breaks the structure, right? And then coming back down to mitigate, I can't just assume that this is my next buy, right? Because this is a swing low, because this low took out liquidity. And I'll show you right now in another little example right now. So let's go here. And this is what I'm talking about. When you do have a swing low created, it has to take out liquidity. Price then runs. You can't just assume when price comes back to your demand zone to start buying immediately. Okay. This is what we called a smart money trap, SMC trap, which we'll talk about later in this video. But stay with me for instance. I want to talk to you about this a little more. Now, why is this an SMC trap? It's because there's no liquidity that was created in here, although you can call these little impulsive moves as liquidity, which it is, but it's not liquidity that you can physically see in here. Like I'm talking about something that's meaningful, big, you know. And so one of the reasons why you can't assume to buy here is because when there is no liquidity, okay, when there is no liquidity, you want liquidity to create. So let's begin. When there's buying pressure coming in like this, then price coming back into this demand zone, taking out this low, this is already considered liquidity. This is an inducement, okay? Then you can safely take the entry after the sweep, take the entry to ride the market bullish. Okay, this is just one of many concepts that we do. However, liquidity must be present. Now, just so you guys can see what I see first before, excuse me, let me rephrase that. I'll show you what I see first rather than what I used to see first. Okay, so a lot of traders, again, see supply and demand. Essentially, all they're looking for is a low and a high, right? And you're just taught to look at supply and demand zones. In this case, I'm not looking at supply and demand zones first. What I'm looking at for first, okay, put as priority, is liquidity first. Now, this helps me indicate when there isn't liquidity, there's a high probable chance the price is going to sweep it, and then we can match our supply and demand zones with the liquidity that's provided, okay? So let me explain. Right here, this is an inducement. Here's a demand zone. Let's make this demand zone kind of close to this inducement here, okay? And we had this low swept, okay? And then we have, this is the demand zone right here. Okay, demand zone can even be like this. It doesn't really matter. You just need to understand the concept. Once I see liquidity, then I can apply my demand in my supply zones. Okay, both of them are swing highs and swing lows. So this is considered a swing low because we took out the liquidity and we chopped. This is considered a swing high because it took out liquidity and it also chopped. Okay, so this is what we call a confirmed range. Okay, when you see this, this is considered a range. And it's considered a range because it is the range between this low and this high, right? Between this low and this high, what you're looking to be trading from. Okay, that's your range. So this helps me to identify and confirm that not only is liquidity swept, but also our supply or demand in this case right here is also mitigated, which means we can safely take entries here to continue price bullish, to take price to the next move, right? This is how it's done. So there's many concepts, but I'll just show you a few in this meaningful example here so you guys can play along and watch. And we're going to go into a live chart example. So let's say again, price comes here, it sweeps, we buy, right? Once price goes up, right? Price can do something like this, right? Then price runs again, right? Now price comes back in, right? Here's where smart money trap is, the SMC trap. Price comes below, mitigates a demand zone, right? This is where you and I would be ready. However, I'm already looking at liquidity first. Okay, look at liquidity first before you see the supply and demand zones. Now, this is really helpful for me. I don't know about you guys. You guys should go and see this for yourself, obviously, and test this out on your own, right? Because we know the markets are, anybody can see the markets in their own variation, right? So I just spotted liquidity right there. I drew my eyes down to the nearest demand zone, and it has to be a swing low. And then I can see a low here, another high here. right? So now we have a swing low. It took out liquidity. Price ran up. Swing high took out external liquidity. This swing high comes down to take out internal liquidity. So we have a chalk. External liquidity swept, chalk right here, price coming bearish, mitigating a demand zone. And you and I are expecting to look for prices to run bullish. Okay? Just like this. Okay? Something like that. Now here's another example. Let's go. Let's just do this actually. There's really no right or wrong way to draw this, as long as you understand the concept, of course. Let's go to the left here a bit. Okay. So let's say price broke the next high, right? And then now we're going to look for prices to run bearish again. Because what are we doing here? We are following order flow, but the only reason why we're following the order flow is because there is liquidity swept. We identified the liquidity, right? Let's say price comes down to the demand right now. Are you going to be looking to buy? Is there any noticeable liquidity inside between this low and this high? There is a swing low. We can see that, right? There's a swing low here. I don't know what that is. It's just a high, actually. There's no swing high created yet. Okay. So there isn't really anything in here, okay? So what my expectations here is to wait for liquidity. So how do I wait for liquidity? What do I do? I mean, obviously I sit on my two hands, but we can either expect price to move bullish here, right? It could do anything. It could even bounce here a couple times, right? Maybe 3 times, right? Just like this. Then you see the liquidity. We still have a swing low. Once price comes in, sweeps liquidity, it can run up, right? That could happen. Let's look at another example. Here's the last example I'm going to show you guys. Let's just draw the rest of this out here. Okay, price runs up, takes out this high, right? Now, again, price comes back down. Here's a demand zone. Are we ready to buy here? All right? There is no liquidity, no internal liquidity. So what do? I have to look for liquidity. So far, I see a bunch of liquidity creating here, right? So what does that mean? There can be buyers here to get faked out. This is where the SMC trap is, right? Price comes below, takes everybody out. Once that happens, right, that is liquidity. What do? You want to pair up the liquidity, right, with the given supply demand zone, right? So in this case, if it swept here, it actually came here and it mitigated this demand zone, right? So that is a swing low with all this liquidity. It's not just this liquidity, but you can see the whole trend line coming in, right? Just like that. This is all trend line liquidity. So price takes it out, right? Takes out that liquidity. And then what do you and I do? We wait for prices to, we can just pretty much just enter here or wait for your confirmation model, right? Wait for some sort of liquidity. Maybe there's more liquidity here, and then price runs up the other way. Okay, just like that, right? So notice how I just created supply and demand with liquidity. But supply and demand is also can be worthless if you don't trade the liquidity right. If you don't see liquidity, say for example, what I drew probably in the very first drawing, right? If you see a low and a high like this, price comes here, right, to demand. Don't be buying from these areas, right? These are just liquidity traps, right? Something like this, right? Look at this. We have a swing low, right? Price comes here, people are buying, and all of a sudden price comes knocking bearish like this, right? Taking everybody out, right? Because you're buying where the traps are, right? Let's say prices run bullish, right? What is this? This is liquidity. This high swept this, so that's a swing high. A bunch of liquidity swept. This high also broke this low right over here. So we can take a safe entry here, selling, right? Something like that, right? So the idea here is to always look for liquidity. And liquidity should be the first thing you prioritize before you prioritize supply and demand. It's 10 times more easier and quicker, right? Because we know that the markets don't, the theory goes like this. The markets don't have to come and mitigate a supply and demand zone. You can also see that the markets can also just create supply and demand, like so. Let me show you here, right? They can also create liquidity, right? But the markets don't have to come back to this demand at all. They could keep pumping bullish like this, right? Maybe come back down here, right? Sweep liquidity in here, internal liquidity, can take the markets bullish again, right? So while you're waiting and sitting here, waiting for buying to happen, right? When the markets, we expect the markets to come back here, the market's already doing something else already up here. Notice how I spotted liquidity first before supply and demand. Swept that liquidity, and now I know that I'm looking for buying pressure because I'm already looking for buys. So in this example here, liquidity swept, right? I would have looked for some confirmation internally and here on the lower time frame to take price bullish.